If you've got an overdrawn director's loan account, you could be on the hook for tens of thousands of pounds. And if you get this wrong, it could cost you absolutely everything, including your home. Right now, there are directors all over the UK facing insolvency, and they're only just finding out that they owe huge amounts of money back to their own companies because of their overdrawn loan accounts. If you ignore it, or if you leave it too late, the liquidator won't just ask you to nicely repay it, they will take legal action, and in some cases they could bankrupt you or even force the sale of your home to get the money back. I have spoken with directors who've decided after a conversation with me to go with the cheapest liquidator, and they've ended up paying tens of thousands of pounds back in fees that they were never told about. In this video, I'm going to show you exactly how to find out if you've got an overdrawn loan account, how much you owe, and most importantly, how to get the best deal possible if your company goes into liquidation and you're asked to pay it back. So stick around, it genuinely could save you a fortune, this video. My name is Chris Worden, I'm from Director First, and we help directors like you get through the hardest times in business. Now, if you're staring down the barrel of insolvency and you've got an overdrawn director's loan account, it can be terrifying. You're worried about personal liability, losing your home, losing your savings. Everything you've worked so hard for could be taken away. Here's the good news though, you have got options, but the earlier that you act, the better the outcome. Listen, let's get into it. What is an overdrawn director's loan account? Let's start simple. A director's loan account, or a DLA as it's widely known, is a record of money either that you've taken out of the company that isn't salary, dividends or expenses, or put into the company. It's like a ledger. Now, if you've taken money out of the business, say to cover, I don't know, meals, holidays, personal expenses, or paying yourself an extra few quid when things were tight, that goes on your loan account. If your company goes into insolvency, the overdrawn balance on a director's loan account becomes an asset that an insolvency practitioner will pursue you for. So let's say you've taken 50 grand out of the business and you've not made enough profit, so that 50 grand sits on the director's loan account as a debit. You owe the company 50 grand. And that is what an insolvency practitioner will come to you for once they're appointed. Now, lots of directors don't know if they've got an overdrawn loan account, or even worse, they don't understand the up-to-date figure. Now, I'm going to try and explain this as simple as possible, right? You might have thought that you were taking dividends and salary out of your business, okay? Here is the problem. You don't take dividends out of a business. Most people are told to take a little bit of salary and top it up as a drawing, okay? And that drawing is in anticipation of your company making a profit at the end of the year, where your accountant will declare a dividend, okay? Now, the only place that you can check whether you've got a director's loan account and it be accurate is really either final accounts done today or done up to the last point of trading where nothing's happened since those last set of accounts, or management reports. Now, first thing you could ask for is a copy of your latest management accounts from your accountant. Or it could be, if you've got access to say Xero, you pull off a trial balance. And it's the same in Sage, it's the same in QuickBooks, I assume it's the same in things like Free Agent. And when you pull off a trial balance, you look for a section that says Director's Loan Account. And it might be in the debtors section, so it says debtors, other debtors, or it might be in its own section that says Directors Advances, right? Now, it's in this section, it will show you what the figure is. And either the company owes you money, which means that the director's loan is in credit and you're a creditor of the company. But if it's under the term debtors, that is a problem, okay? Because that means that this money is owed to the company. And you have got to get a hold of these numbers before you do anything else. Now, let's say that your QuickBooks or your Sage or your Xero is out of date. It's not been updated. You need to spend some time bringing that figure up to date. It's really, really important. Because if you're going into insolvency, not understanding this director's loan position, you're going to have a bigger problem than you think. You've got to check that the director's loan account figure that you have in your mind, be it from your accountant or from your accounting software, is accurate, okay? Because if you're taking your director's loan account from last year's figures, last year's accounts, or a Xero that's not been updated, there's a damn good chance it's going to be wrong because they're based on old data. So things you should be doing is making sure all transactions are accounted for, okay? Look at the director's loan account ledger with your accountant and make sure things like mileage expenses, legitimate business expenses and reimbursements have been deducted, okay? If you've spent money on company money on personal things, that's going to be in there. But sometimes the accounting can be wrong either way. Get your accountant to justify the number. If it's wrong, now is the time to fix it, not after the insolvency practitioner gets involved, okay? Now, once you've got that number and you understand where your director's loan account sits, and presumably if you're still watching, it's overdrawn, you've then got to speak to an insolvency practitioner and talk about this up front. One of the mistakes that I see is directors wait until the last minute to talk about a director's loan account. Or they don't talk about it at all and they sort of think, oh, well, they're not mentioning it, I'm not mentioning it, I might have got away with this. That won't happen. Once you've appointed an insolvency practitioner, it's very, very hard to change anything and it's harder to get deals done. Your leverage is gone. Now, if you speak to them early, right, you've got more chance of negotiating before they're officially appointed. Now, I've got to put a caveat here. An insolvency practitioner cannot formally agree on a deal on your director's loan account before you appoint them, okay? Everything will be in principle. And the principle is you've told them everything. So I'll tell you what we do here. When we're doing these director's loan account deals or helping you understand your position, we'll go through what I've just said. You know, we'll help you work with your accountant, we'll help you understand your accounting software, and once we've got that figure of what your director's loan account is, we will speak to one of the insolvency practitioners and we're going to be going to them with your income and expenditure so we can tell if you've got any money left at the end of the month. And we're going to be going with your assets and liabilities, okay? And we're basically showing them what your personal position is. And in principle, you'll be able to get a settlement done on your director's loan account before you sign, before you spend any money, okay? A good insolvency person will work with you, right? You've got to remember the insolvency practitioner has their duties to creditors, okay? They're not there to protect you. They're there to do what's right by everybody, and their main role is to represent creditors. Now, I've seen directors settle directors' overdrawn loan accounts for pennies on the pound, and I've also seen directors chase for the full whack because they've waited too long or they've not taken my advice. Now, one of the things that's going to help you get a deal done on a director's loan is knowing what your personal finances look like. Because when it comes to negotiating a deal on your director's loan, an insolvency practitioner is going to want to know if you can afford to pay it. And here's what you've got to do. You've got to list up all your assets, house value, savings, you know, watches, anything that's a personal asset, and list all the liabilities, mortgage, credit cards, loans, any other financial commitments. And what it will do, we can also work out your equity in your home, which is essentially your house value minus the mortgage. Now, you've got to be honest with yourself at this stage, okay? There's no point telling me that your home is worth a lot less than what it is, or that your mortgage is a lot more than what it is, because obviously these deals will get done in principle, but once the insolvency practitioner is appointed, they're going to want to see the evidence. They're going to want to see a redemption figure on your statement on your mortgage. They're going to want to verify that the value of your house is what you've said it is. Now, when you're getting these deals done on directors' loan accounts, the idea of you getting a better deal than what you owe is essentially the insolvency practitioner has got to realise a better amount of money off you than they would in a bankruptcy. And I know that word scares you to death, right? But understanding this is going to give you power. Let me walk you through some example figures, right? There's a property of a director I've helped. It's worth about 250,000, right? But in a bankruptcy, it'd be a for sale would essentially mean it'd probably be worth 90% of what it's actually really worth. So let's say its real value is 253, and 90% for sale value would be 227, right? The mortgage on it is 65 grand, which means there is equity of 160,000. But then we've got to look at other debts, okay? Because on the face of it, that looks like there's a lot of equity in that property. But when you factor in what would it cost to make that director bankrupt to realise all that equity, you've got to understand making someone bankrupt is expensive, okay? Here are the typical costs of making a director bankrupt. 2,400 is a petitioning cost. The official receiver will charge 6 grand plus VAT, 7,200. You've got a trustee in bankruptcy and they will typically charge 15% of any realisations. So whatever gets realised from the house of the sale of the house, bang, they take 15% of it. Now, there's also a solicitor's costs to make someone bankrupt. And if you're going to play silly buggers and not comply with the insolvency practitioner, that solicitor's cost could be up to 20,000-25,000 quid. There's trustee expenses. They'll probably charge £1 grand in expenses. Plus, the houses need to be sold at a discount, remember? And when you're selling a house, there's estate agent fees. There's conveyancing fees. And if that director, if you have personal debt, like loans and credit cards, they're going to get a share of any dividend in a bankruptcy. And we've not even mentioned the insolvency practitioner's fees, because they don't work for free. And when you figure all those costs out and you put it to that insolvency practitioner, it gives you a good starting point for a negotiation, okay? Because as long as they can bring in from your settlement more than they would if they made you bankrupt, it'll get accepted. Now, if you've got no assets, you're in rented accommodation, you've got no disposable income, I mean, if you was to offer a few grand on a 50 grand debt, the chances are they'll accept it because you've got no assets. So the few grand that you're offering is more than this insolvency practitioner getting a bankruptcy without the cost of making you bankrupt. It's in the creditor's interests. You've got to remember though, if you've got assets, it's going to be higher. But them settlement cost of bankruptcy that I've just mentioned to you will give you a clearer picture of how you can go about this. Now, another thing that an insolvency practitioner is going to want to know if you've got an overdrawn loan account is like your income and expenditure. And this is where a lot of directors fall down. The IP or their solicitor will want an income and expenditure sheet, basically seeing your personal budget. And what they want to know, what's all your income, salary, benefits, you got any rental income, what are your expenses, mortgage or rent, council tax, utilities, food, petrol, and have you got any disposable income? What's left over? Because let's say you've got £500 a month spare, the insolvency practitioner may ask you to enter into a payment plan with them over a number of years. Now, if you've got nothing at all, right, and you can raise a bit of money perhaps from family and you offer an insolvency practitioner, the chances are they'll bite your hand off, okay? Remember, if you've got nothing, it's very easy to deal with this director's loan account. If you've got £1 million property with no mortgage, you're in big trouble because it's very unlikely you're going to get any deal, because even factoring all them costs of bankruptcy, if an insolvency practitioner was to make you bankrupt, they get all the director's loan account back and they get the costs. Now, all of this that we've discussed, this director's loan account review, the settlement calculator, the income and expenditure, the cost of bankruptcy, you need to use this information before you appoint an insolvency practitioner. And I'll tell you why. Because once appointed, they've got no real mind to do a deal with you. Remember, and I'm not saying they're doing anything wrong, they've got legal duties to get the best return for creditors. Deals are harder to negotiate after the fact. Now, I'm not saying insolvency practitioners are doing this wrong. I put a post out on LinkedIn yesterday. What I'm saying is there's a better way to do this. What we do at Director First, if you put the phone up to me today, I'll help you understand your director's loan position. I'll help you understand what a settlement would look like if you go into insolvency without asking you for anything. I don't want any money off you. I don't want any advice fees. I don't want any commitment. But what I do want you to know is I want you to understand that what is going to happen to you personally if you hit the button on this insolvency. There are a lot of firms out there who skirt over this. They don't discuss it with you. It's a case of some might not even mention it. So others will say, oh, don't worry, sir, we'll deal with that down the line. That is too late. That's going to cause you issues. If you've got a director's loan account that's overdrawn, it's not the end of the world. But if you ignore it, it will become a massive problem. My advice is act early. Pick up the phone to me. I offer free, independent, impartial advice. I have helped thousands of directors over the years. I've got more 5-star reviews on Trust. Actually, I don't have more. I have a better quality of 5-star review on Trustpilot. Go and watch them. Go and have a look at my reviews and compare them to other people. And theirs are like, Mr. Chris was great. And mine are like big, detailed War and Peace off directors. Some have said I've saved a life. It's Chris Worden, Director First. God bless you. Thanks for your time.